joining us once again, I think for the final time, on your tour of London this Friday, today. So it's a big moment for us.
Final time of this tour, just
it's a massive loss. Just for this tour, you'll be back with us.
You're not getting rid of me yet.
With open arms in the next few months. Is this equity market, as we think about the central banks, we think about some of the rewriting in terms of some of the bets around the Fed yesterday on slightly stronger jobs claims data, the ECB, a hawkish hold is the way that Lizzy characterised it, and then the implications for an equity market that's seen record after record, at least 10 for the S&P 500 just in the last 19 days. Is this record rally for the equity markets starting to look a little bit feeble, or is it running out of steam, Mark?
No, I don't think it's running out of steam, and I think it's probably going to go higher again next week in terms that, at least the first half of the week, because you're likely to get more trade deals before the deadline. So we know that the news flow is skewed to be positive in the short term. Now, I am very, very worried about the impact of tariffs and about what happens in August. Now, I should say, clarify that, because I'm very worried about the impact of tariffs, but the real impact from tariffs in terms of the real damage won't come through for months. But I'm worried that we actually still haven't really traded that kind of even narrative yet, that we've just been in denial, because we know that the short-term headline is going to be new deals. So therefore, even if you think tariffs are terrible, even if you're super bearish, why go short now? Why not wait till like next Wednesday or Thursday, just before the deadline, when everyone's going to start trading that narrative? So I think it could shift quite rapidly next week.
Which goes to the point with Sri, you know, are the markets too focused on the country deals and not enough focused on the sectoral deals? I
think that's absolutely right. I think the analysis around tariffs has been extremely hard, because obviously we've had so much whiplash about what the plans are, and you know, therefore, because of lack of certainty, companies are going to delay reacting as long as possible. So they're going to try absorbing it because they're going to hope they're temporary. You can't raise prices on consumers and then find out the tariffs all get removed later on. You do too much damage to your brand. So everyone's going to wait as long as possible to pass them on. They will ultimately all be passed on to the consumer. They'll ultimately be extremely damaging, extremely stagflationary, terrible. But that might be the theme for first quarter next year. It's going to be really slow to come out, but different sectors at different times.
Mark, meme stocks are back. We've been talking about this week, whether it's Krispy Kreme or Coles or GoPro. Does that signal an overstretched market? Retail investors are getting back into the game in a big way.
It does. But again, it's not necessarily the end stages of that. We discussed in the show yesterday, if you find a bubble, the best trade in markets, if you find a bubble, is to go long the bubble, not fight it. Because, you know, you fight a bubble, you'll go bankrupt. So, you know, this is completely ludicrous, some of these trades that are going to meme stocks. But, like, what stage are we in that process? I'm not convinced we're at the end stage. Now, of course, you don't really know exactly when the end stage is, but as I said, I think we could have another wave next week. What is going to make you suddenly sell your meme stocks on Monday, Tuesday next week? Maybe ahead of the Fed, maybe Wednesday you start doing it, but I just kind of think the short term into the Fed, into Friday, a little bit more upside, and then it might go really bad in August.
Speaking of memes, have you seen all the Sydney Sweeney stuff? Seems to be encouraging people to buy the meme stocks. Goes over my head. I get my news from memes sometimes. Bloomberg's Market Live Executive Editor Mark Cudmore, we thank you.